Hi guys, Casey Dimon here with the TaxSaleAcademy.com. In this video we're talking about determining tax sale bid amounts. Now obviously one of the most important aspects of tax sale investing is determining how much you are to bid. Now this video is just meant to be a very basic lesson. It's not supposed to be detailed, and by no means are you supposed to use this lesson alone to learn how to invest in tax sale properties and determine your tax sale bid amounts. Inside the Academy, we have much lengthier, much more detailed, and much more informative lessons about determining bid amounts. But basically, I'll break it down in a three-step process. The first thing you have to do is determine the value of that property. That is, of the property you're interested in investing in. The most common method to do this is by using the comparable sales approach method. Now again, this is something I can't teach you just a few minute video, but look at it this way. It basically says that a buyer will not pay more for one piece of property when they can buy a similar piece of property for a cheaper price. So if you have two houses side by side and they're exactly the same, the buyer will choose the cheaper one. So what you'll do here is basically you'll take these comparable properties, you'll figure out which properties are maybe a little bit bigger, maybe a little bit smaller, and then you'll move some numbers around, and then bam, you have a figure, or an estimated figure at the very least, for the value of the property you're interested in investing in. Step two is you'll take this value, this estimated retail value, the ERV, and then you'll discount it even further. You know, we don't sell pieces of property at retail value every single day, and the reason is because it takes a long time to sell a piece of property at its full and fair market value. So instead we discount these properties. We discount them to a wholesale price. Now, my wholesale price and another investor's wholesale price might be completely different when you're talking in terms of percentages compared to the estimated retail value. My wholesale price that I use is a number that I know I can sell a piece of property at very, very, very quickly. You know, usually within days, sometimes hours, and even sometimes minutes of pricing that property at this wholesale discounted prices, I will sell it. You know, compared to other investors, they might take 10% off of a retail value. You know, I'm going to cut the retail value down substantially, and I'm going to say this is my wholesale price. This is the figure that I know I can sell it very, very quickly. And then from there, step three is you use that wholesale price to determine your bid amount. Now, on the lower valued properties, you know, say 10,000 or even 20,000 and under, I want to use what I call is the 1/3 rule. Basically, I will triple my money. You know, if I pay $5,000 for a piece of property, I need to be able to sell it at my wholesale price, which should be $15,000. I will not pay over $5,000. You know, if I'm buying a piece of property, for instance, for $1,000, I need to be able to sell it for $3,000. Now, as the prices increase, you don't have quite this buffer. You know, you can't buy a piece of property for $500,000 and sell it for $1.5 million and make $1 million. It just doesn't work that way. You know, there's not quite that much real estate you can purchase at tax sale auctions that is that beneficial. Some of the lower value properties, yes, absolutely. There's so much of the lower value properties you can. For the higher price stuff though, you need to become a little bit more lenient. Maybe you need to set a goal and say, hey, I'm going to double my money. You know, if it's over $10,000 or $20,000, my goal is to double my money. So if I spend $50,000, I need to be able to sell it for $100,000. You know, and I don't use the 1/3 rule or the double rule, you know, just because I'm a greedy person. What we have to remember here is that number one, you're investing a lot of time, a lot of effort, and you need to be rewarded for it, of course. But number two, you also have to remember that these properties are being sold as is, where is, and most of the time it'll be without any inspections whatsoever. You know, this isn't a typical real estate deal. You can't have your home inspector poke around in there and find, you know, each and every single screw that's loose. This is something that you're going to be buying, you know, most of the time you'll drive by it. You might even get a peek in some windows if you're a very, very brave soul and the property is unoccupied. But a lot of times you'll just be able to drive by the piece of property and say, yes, I can buy it, or yes, I'm not going to buy it. You're not going to know what's under that shell. So this buffer gives you a lot of room. You know, if you buy a piece of property for $50,000, for instance, and you expect to wholesale it at $100,000, and you get inside and realize that it is completely gutted, all the copper, everything else is gone, you know, then you might have to drop your wholesale price down a little bit. So it gives you, you know, a buffer more or less. So there's a quick and a brief lesson on determining your tax sale bid amounts. For a much more detailed and much more informative lesson, consider joining the Tax Sale Academy. Or at the very least, head on over to the TaxSaleAcademy.com, which you can do by clicking the blue link right here next to my head, and get your free copy of my ebook, The Tax Sale Investing Blueprint. Have a wonderful day, folks. Take care. Bye-bye.